Hello, folks. Brandon Chapman today. It is a Monday, October 28th, 2024. Boy, we're heading into Halloween. It's pretty scary, but as you look at the market generally today, it doesn't look very scary, only being up 1/3%, but the waters are not calm, and we'll talk about it. It's a mixed up market as oil slips and bonds dip today. So again, up 1/3%. One of the things I like to look at first, how much can I attribute the rally in the market to the dollar's weakness? And as I look over here in gold, gold was basically flat on the session. The S&P was able to eke out a real return of 1/3%. You might think that's kind of exciting. Hey, we're up today. Financials up 1%, materials up 0.8, utilities up there as well at 0.78%. The reality is we have a lot of stuff coming up this week in terms of both potential geopolitical risk. We have an election in a little over a week. A lot of stuff transpiring beneath the surface. And guess what? That is being reflected right now in the VIX. The VIX is currently standing at 19.8. When did you ever see with the market virtually at all-time highs at a 20% handle on the VIX? You just don't see it. It's about the perception of future volatility that's really being baked in the cake right now in the market. As you look at a secondary measure of skew ticked up on Friday to 148. The market perceives that there's a degree of crash risk in the air, anything over 130 being relatively high. Well, if we kind of take a look at this thing, the market, why was it up 1/3 today? Financials are doing well. Well, look at oil. Oil is kind of a bellwether for the economy. Oil slipped 5% very unexpectedly. I mean, you had, for example, Israel retaliated against Iran, and you think, wow, that's going to stir up something. You would be wrong if you thought that, because inevitably oil's down 5% today. Maybe they didn't hit military installations. They didn't hit energy production. They hit military installations. But how is that really? Can we shrug off on that level of an attack? Just shrug off the risk in energy overall is pretty crazy. And you look at this. You look at /HG, which is copper. Copper's been relatively weak. Again, today, gold's been flat, trading at highs. But the point is that this is not necessarily this great market that you're looking at here, right? And you'd think, if oil prices go down 5%, surely that kind of diminishes the outlook for inflation, and bonds should do better. Well, look at /ZB. This is a 30-year Treasury bond. It's down about 0.5% today. So if we look, for example, at TNX, this is 10-year Treasury yields. We see what happened there. Again, yields breaking out to a new high again, the highest yield since July 24th earlier this year. We had a pretty poor 2-year bond auction. Well, why? You think, if oil prices are down, doesn't that lessen the threat of inflation? Doesn't it lead to potentially lower prices in the future? Well, the problem is that lower oil prices are very transitory, right? As the Fed usually says, core, which strips out food and energy, versus headline CPI, which includes it. They like to look at more core numbers and take away those because of the volatility. Well, you get an announcement from the Treasury today that they expect to borrow $546 billion in Q4. And that's after a big jump in borrowing just in recent weeks. And so all this is really just putting pressure on the bond market, because oil prices are transitory. Inflation created by government borrowing and spending in large S ultimately is way more structural. And so if the fact is yields are rising, and so the market just didn't get the benefit today that you would expect with oil prices down 5%. You think cyclicals would be doing better, not up 1/4% today, but gapping and fading. If we look at the SPY, there are some key levels here, and you look at, for example, 579.97. We kind of sold off almost to that level today. That was a 1 million share print. That's one trade back on 10/11. It's been acting as support and resistance. And so we'll see what transpires here in the next day or two. Do we break below it and the market heads lower? Do we continue to be bottled in, or do we break out? And so one of the areas that has shown strength today, for example, is your kind of clean energy stocks. ICLN was up 1%. Solar companies we're up 2.3%. Wait a second. Didn't oil prices just decline by 5%? And somehow this is bullish for alternative energy. Lithium America is up 12.5% today. This is a trade I talked about here last week and in my sessions. Little Rico back here at 320. It's up nicely right now. We were looking at a $5 target price on Lithium Americas Corp. Americas Corp. And again, why are these guys up? Battery generation? Oil prices just slipped 5%. Shouldn't that place greater strain on alternative forms of energy? No, not in this mixed up topsy-turvy world. It doesn't mean it. Dollar today is basically flat, both in relative and real terms. We talked about last week during my sessions about some option activity in the Chinese market. FXI was up 1.73%. ASHR was up about 0.5% today. Again, if the dollar begins to weaken, again, we're borrowing a lot of money. Yields are going up. Does this mean in the near term we could see some degree of pullback in the dollar? We start to see DXY decline here. This could emphasize some of the Chinese markets like FXI, KWEB, ASHR. You could look at EM, which has significant exposure to China. We may be seeing highs if the dollar begins to pull back on this news. And again, financials. Why are financials doing so well? Well, guess what? We had a big kind of engulfing formation on Friday. This is basically getting back to where we were last Thursday. I just don't feel as secure with the rally today, but here's the deal. If yields keep rising on the 10-year, on the 30-year, yes, there are unrealized kind of losses in the Treasury market, but what we've seen as a result of earnings, like companies like Capital One, for example, last week pulling money out of loan loss reserves, but more importantly, they're passing on the higher yields, higher interest to consumers. And so if the Fed did not get you on the way up by going from ZERP to 5.25% to 5.5%, they're certainly getting you right now on the way down as long-term Treasury notes and bonds yields are rising, and they're passing on those higher costs to consumers, and it's helping banks make more money. JP Morgan announced on their earnings back here, higher net interest income. The Fed has achieved a steeper yield curve as a result of their preemptive 50 basis point cut. So where do we stand right now? Yields rising in the face of falling oil prices, geopolitical risk. And by the way, we have an election coming up next week that certain states are suggesting, certain counties, they're not going to have results for 2 weeks. The point is that right now may not be the best, that may be the best time to begin to take profits as the market is stretched near highs right now. And the realities of the downside could be very real. We had a breakout in the SPY, for example, on the 23rd from this rising wedge. And again, the target's 540. Some of the volatility signals we got in mid-September looking for a 5 to 10% correction. The stubbornly high VIX right now, right, suggests the downside risks are very, very real at this point in time. 540, maybe 500. The upside certainly might be there, but the high skew says that the upside will be slow to come, meaning we grind until eventually we do finally get the profit-taking event that we have. Why not just preemptively just consider taking profit into strength? That was a strategy that today Don Kaufman applied to our catapult portfolios, recognizing the risks. And if you got 40, 50% profits, 30% profits, do you just decide, hey, maybe I want to take it off the table, pull the chips off and decide, hey, you know what? I'm going to wait to see what happens post-election. And that might be exactly what the market's anticipating right now. One key to point out is on IWM today. IWM, there was a significant role in the options market. And this is just what? This is hedging. But if we look at the November 2000 to 211, let me scroll up here on the put side. You'll see right here, 211, 94,000 contracts against 40,000 open interest. This was rolled up from the 208 strike. So we're selling the 208, we're buying the 211. What's happened? The market's up $3 in IWM. Guess what? They just moved up their hedge this morning for $3. Okay, there's a necessary desire, a need to keep those hedges in place in case the market does correct. And so the idea is, why not follow suit? Why not just consider taking some degree of profits, raising the cash levels, lowering the directional risk at this stage? I shared some stats on our Theo live broadcast on Friday, and that was that the fact that the biggest drawdown in the S&P 500 was 8% this year, but against a backdrop of the average S&P 500 stock experiencing drawdowns over double that. The NASDAQ, the biggest drawdown this year was 13%. The average drawdown among NASDAQ stocks were 46%. What does this really mean? The fact is that most of us are taking more risk in the market than we probably recognize at this point in time. And a 10% decline, let's say, for example, back here to 530, a 10% decline, you might experience 40 to 50% portfolio drawdown holding onto those same stocks. Because why? We're probably in a more higher beta mode as individual retail investors, not recognizing the risks just beneath the market. But if you take a look at the average S&P, the average NASDAQ drawdowns amidst relatively modest drawdowns in the indices, it suggests that overall, you may not necessarily be comfortable if after the 10% correction, you look at your portfolio value and the drawdown. It says right now it's time, no time like the present, to really look for opportunities to take profits into strength. I'm not saying taking losses, but if you could raise 30% cash, cash out some of it, that'll give you a chance to redeploy if we do get a correction. And if you break out, guess what? You can always buy high, sell higher. But right now, the elevated risk of the market suggests that, look, this is no time like the present to consider to take some money and run with it. That's all I got for today. We'll catch you back next week. Thank you.